I want to make sure that if I'm trading something like a breakout where I'm expecting a significant move, well, I need to fit the right strategy to that opportunity. In a breakout style trade where I might get a really big move, I don't want to cap my profit.
So today's sitting down with Erik Smolinski. Welcome to the podcast. Good to be here today. And for us to talk about trading with you.
Awesome to connect. Thanks for having me on. Looking forward to chatting.
Awesome. Let's begin with this. Tell me kind of how you started trading in the first place.
Yeah, so I started trading back in high school. So it was 2007. And I was introduced to investing through a teacher first. And I thought that I was going to be an investor. And then, like most late teen, early 20-year-old dudes, I was hyper impatient and I wanted to make money faster. So that's when I started learning a little bit about trading. And that's also how I found my way into derivatives, options, that kind of thing, was for that exact reason.
Tell me about kind of your life before trading, and then how did you actually make it work or become profitable?
Yeah, for sure. So life before trading, like I said, I started really young, but I grew up pretty poor. I had a single mom. So money was always super tight, and I always felt some type of like discomfort around finance because of that. And I started working a lot as a young dude. So kind of like starting in my early teens, I started doing a bunch of different odd jobs and stuff, just trying to save money. So that's one thing I knew would be good, was to save money. And then from there, that's when I met that teacher that got me into trading. So this is all still literally when I was kind of in like really, really formative years in, high school is when I came across markets. And the starting point was super fortunate. The early advice that I got was, investing in the things that kind of standard advice. And I found stuff that was really interesting, but it wasn't moving that much. So then that's when I started looking into actively trading. Day trading looked really, really difficult at the time because, again, back in 2007, obviously we had technology and whatnot, but it's not like it is today. Like there wasn't something I could pull up on my phone to day trade. So I thought kind of swing trading, that kind of thing would make sense. And then I found my way into derivatives coming across another book. And when I came across derivatives, I don't know what it was about derivatives. I guess it was just the fact that like it was a massive challenge up front to even understand what I was looking at. Like if you've ever traded derivatives, for anybody listening, at first it's like a completely foreign language. It's completely different than everything. Even the way that we use debits and credits is reversed from standard accounting, like everything. So I kind of fumbled around for my first couple of years. I was negative, but not much because I was really risk averse. So I wasn't willing to put on big amount of money. And it goes back to all that psychological stuff from growing up really financially constrained. So like the money that I had, I was like holding on to. I was too scared to risk it and give it up, that was a big thing to eventually overcome. But those first 2 years of trading were actually my only negative years. So from essentially those periods forward, and the worst drawdown was less than 5%, or the worst loss on the year. I've had bigger portfolio drawdowns than that. But the first 2 years were slightly negative. The next few years after that, there were nothing impressive. But I started at least getting my feet under me enough. But it was really difficult for me to put money to use, which in the beginning was kind of beneficial to me because I would have lost way more. Like if I had a slightly different relationship with money, I probably would have put on trades way too big and lost a bunch, my guess is.
That's a good point. Tell me how you change that mindset, that money mindset, to where you are able to risk a bit more, still like conservatively.
Yeah, man. If you want to talk about like because I still consider myself to this day too risk averse, and I'm 33, and I've done fortunately very well trading. I'm very thankful for that. I've started spreading into other asset classes like commercial real estate, angel investing. I started spreading as I started developing like a base level of wealth that I was comfortable with. And there's two things that I think about. The first thing is something you've all heard before, but the money that I put into a trading account, I think there has to be a psychological detachment from that money. So I literally started putting myself through different exercises where I would open up my platform and then I would pretend to see another number. I would like literally visualize seeing red, even if there was or wasn't red in terms of, the account P&L for the day. And I would kind of like put myself through the visualization process of like actually thinking about the account being a different number than whatever it was. So like, let's say it was red $1,000 on the day or something super small. Well, I would add a 0 to that mentally. And I would just start to try to like desensitize myself massively so that I can try and get used to seeing that kind of exposure. And the only way I was able to get there was the money that was going into the account. I genuinely would view it as money that I was not getting back. And that was really difficult to do in the beginning because I put all of my savings into it. So that didn't work well with one another. And it leads to the second thing that I did, which was as I looked at the capital, I made sure that I had enough in savings that I was comfortable, that if the account were to draw down massively, that my livelihood isn't challenged at that point. The ability to feed myself and stuff like that is not challenged. And I can like truly focus on the skill set with the trading capital. And I would say the third thing to tack on a bonus one is I started doing a lot of paper trading. And by doing a lot of paper trading in the beginning, I logged a ton of it in Excel so that I could actually see the skill set. And I can like, I was able to really amplify the number of trades I could put on, right? Because my account would run out of money way before I was at the end of, what I could put on. And the process of paper trading is really sneaky in that sense, because if you treat it with respect, it can teach you a lot about a perspective system that you're trying to run. And long story short there, confidence to me comes from a demonstrable skill set. The ability, it's not from like just hyping yourself up and thinking like, oh, I'm the best. Because if you don't actually think that, because you don't actually have any sort of track record to back it up, you don't actually believe it yourself. You're just saying shit. So when I look at the ability to start scaling up capital a little bit, the biggest thing was really starting to look at the skill set and say like, okay, there's losing trades. I'm okay with losing trades, but I can see in the aggregate, this is working well. This is worth putting my money into. So those are really the three things: psychological detachment, making sure that you have enough saved so that you're not eating into essentially what maintains your livelihood, and then the skill set validation.
What are some of the changes you made from your first 2 years to then the years where you actually became profitable? Was there like a few things you can recognize there, or was it like a bunch of different things you changed, or what happened?
Yeah, well, there was definitely a bunch of different things that I ran through, but the biggest one, bar none, was getting organized. Because especially with options trading, there's a lot of different structures that we would call them, right? You can buy or sell to open trades just like you can with stock, but then there's all these different kind of legs you can build to make these really complex structures. And in the beginning, a lot of us in options trading think that there's edge in options themselves, and there's not. Like, options are just a product. It's just something to trade. It has slightly different behaviors, pros and cons, of course, but there's nothing that if I trade an option, I'm inherently going to make money, right? There's no baked in edge. So the first couple of years of trading, it was just pure randomness. I would have a really haphazard approach where I would come across vertical spreads and I was like, oh, wow, these look really great. They're defined risk, defined profit, higher probability trades. This looks great. And then I would trade them for, a couple weeks. And then I would have like 4 losing trades. And then I would start tinkering with what I'm doing. And then it would work again. And then I would have losing trades again. And then I would tinker with it again. And by the end of that, you look at the what you've done with this system, and you have this thing that never had a chance to even show you its actual returns because you're not giving it any time. And I'm not confident in it because I didn't back test any of it. I was just kind of, figuring it out on the fly. So the biggest thing that I did to pivot all of that was starting to get supremely organized. I developed a written trading plan. I developed a trading log to actually document the different changes that I was doing. So then if I'm selling a 30 delta, short call and buying a $1 wide wing, maybe in paper trading at the same time, I would test doing a $2 wide, $3 wide, $4 wide. I would test different short deltas so that I could actually see how these things worked before I would make a random change because of bad path of returns and then really have nothing to show for it. It was just complete randomness. So getting organized, hands down, pivotal.
I think a good point too is like getting data is also really huge. Like knowing what works, what doesn't work. Tell me about how did you keep track of that? Was it like an Excel spreadsheet or was you able to track that?
Yeah. So in the beginning, it started with Excel. And then as I came across different people in college, I actually have a buddy that I played rugby with that he's into like computer programming and stuff like that. So he helped me understand some basic coding through Python and things like that. So I would automate pieces of it. I actually had most of it automated for a while from a logging perspective. But then I actually realized that I was getting, I don't know, I was like losing sensitivity to like what I was doing on a daily basis. And like the actual manual entry process for me is like really important. It keeps me so close to each metric that I'm looking at versus just getting a readout. So I've actually regressed back from having everything automated to now going back to Excel and Google Sheets.
I think having that touch of like you look at the results, you enter your data yourself, kind of that helps to understand things better sometimes.
Yeah, and it keeps you super close to it. So it's not like just getting a readout of, you know, this trade was a losing trade and it's just a number, right, that you're looking at. You can actually, like, as you're inputting that losing trade, it's a different experience than just seeing it spit out to you. So yeah, I found it really, really useful. I do automate elements of my trade log and stuff like that for efficiency. Like I don't want to sit there and have to manually input stock price, right, when I'm comparing entry versus exit. So I can pull that kind of stuff in. But yeah, like most of the actual components that are relative to the trade and the strategy, those will be manually input for me.
Tell me about your trading style these days. What do you kind of focus on? I know you trade options, but you want to go more in depth on that into like what that looks like day to day.
Yeah. So I am completely agnostic to preference overall. What that means is I do my absolute best to objectively look at the market and then try to fit myself around the market. So most of the strategies that I run are going to be shorter term holdings. Maybe a month would be kind of a longer holding for me. I do have strategies that exceed that for sure. But the overall volume of my positions is going to be sub-month for sure. And I buy and sell premium. So they have different return profiles. And I trade what I call profit mechanisms. I like to think about the stock market in terms of not just selling a put or buying a call, but I want to make sure that if I'm trading something like a breakout where I'm expecting a significant move, well, I need to fit the right strategy to that opportunity. And for those that are unfamiliar with options, if I sell a put, I have a defined max profit. So it's a higher probability trade. But in a breakout style trade where I might get a really big move, I don't want to cap my profit. Doesn't make any sense. So I think of trading very much in that sense. I try to develop a series of profit mechanisms. So price movement is a big one. And then I sub-categorize price movement. So you can have things like drift, momentum, trend, breakouts, breakdowns, stuff like that. I guess you can call breakout to the upside or downside. Breakout necessarily, I don't think means upside. But so I trade a lot of that stuff from a directional perspective. And then I also trade volatility directly. That's one of the beautiful part about options. You can't get direct volatility exposure via equities. You can get it through options. So I trade things like variance risk premiums, volatility extremes, whether it's expansion, contraction. I trade relative volatility between like different expiration cycles. So if we have volatility in one expiration cycle that looks a little bit low on the volatility surface compared to others, you can trade those relationships. The way I look at it is I want to have a few different tools in the toolkit because the imperative that I laid out for myself is I wanted to be able to return 15% per year. And if everything that you do is long equity or long deltas, as I would refer to it as, if you have a generally broad down market, it can be really difficult to deliver on that. Not impossible. Even during bear markets, there's going to be stuff that performs well, but it just becomes more difficult to find great opportunities. So I wanted to find ways to trade price direction up and down volatility direction, up and down, and then risk premiums. So it's kind of like the 1,000-foot view of what a lot of it looks like.
What does that 15% per year come from? Is it a measure you've set yourself, or what do you come up with that?
When I was a genius in high school, I came across a compound interest calculator. And what I did was I looked at how much money I had, and then I looked at what I would make in the military. Because I went through college on a scholarship, and then I joined the Marine Corps as an officer. So your pay, you can see your pay, right? It's all a scale. It's not like the corporate world where it's black box. You literally can look it up. So I was just like, okay, if I'm going to be in the Marine Corps, let's call it 10 years, whatever I thought it was going to be. And I thought I could save a certain amount of money. I created a planning factor for that. I wanted to be a millionaire before I was 30. That was the target. And long story short, 15% per year in conjunction with the other stuff that I had planned would get me to that target. So that's why I picked it.
Interesting. And that's the number you follow now.
So now it's guided way down, to be completely honest. Like right now, essentially anything that keeps pace with inflation is fine with me. Now, funny enough, the last 2 years, last year specifically and this year so far, have been some of my most productive years. I actually had my best trading year last year, where that was also my target, essentially inflation. So just because the target is lowered today for me than it was previously, because previously the goal was aggressively grow the account. Now the opportunity set for me is different because I've been fortunate. I've done well. So I'm not worried about like growing the account again through this aggressive growth cycle, but now it's about application of the skill set. So it's taking advantage of opportunities. That's how last year I was super fortunate and actually had my first triple digit return year. And I know, for some people that are used to trading, or if you follow like the US investing championship, stuff like that, that's not going to win me the US investing championship. But as a dude with no formal background in this stuff, for me, I thought that was a really, really solid year for me. So the other thing that I thought about was when I was setting that target, I looked at the stock market and I looked at the average return, which again, depending on the window you look at, it can be around 8%. It can be over 12% if you're looking now, based on your look back window. So I wanted to have some sort of risk premium for putting in the effort to learn to trade, the time and effort needed to compensate versus buy and hold. But I also wanted to make sure that I would outpace the market effectively, but then also not participate in drawdowns. That was a big thing that kind of blew my mind in the beginning. When I realized to outperform the stock market, you don't actually have to beat it every single year. I haven't. But if you can generally pace it, maybe beat it slightly, but then when the stock market has, a down year where it's down 20%, if you don't participate fully to the downside, you reduce your return volatility and you can actually have a better compound annual growth rate without massively outperforming the market every single year if it has a great blowout 30% plus year. If you're trying to be more of a consistent style trader, as long as you generally participate with it but miss the downside, very doable. So the last thing I'll note here is that my approach to building wealth is very different, I think, than a lot of people because, as I told you, I do have a single mom and she worked as a contractor. So she didn't have a retirement. So for me, it wasn't like YOLO Erik's money so that I could see if I can buy an island and then fly a Bugatti over to the island, right? Just to have a bunch of stuff. Like I literally knew that I was going to be the retirement for my mom. So I wanted to build something that was going to be pretty solid that I can like generally rely on. And that's why I focus less on having, triple digit years as often as possible and overall reducing return volatility to something that was highly predictable, because then I could accelerate it. Because then if I was really good at saving, which I was really good at saving, then I have this predictable return more or less that you're able to like really feed this machine and then plan off of it. Because I actually retired my mom last year and she had work optionality before that, but she also wanted to, finish out her time in a way that she was comfortable. She was an occupational therapist. She didn't want to leave her coworkers, all that kind of stuff. So that was another massive planning factor for me. Is it wasn't just a function of I want to make a bunch of money because it'll be sick. It's because I legitimately knew that there was going to be a financial burden because I have a brother. He's a sheriff. He does fine for himself, but he wasn't going to be in a position to like cover her.
I think you make a good point too. It's, a lot of people are trying to get the best returns possible, but it's all about the consistency too, and like how you actually, not necessarily the percent amount, but more the how often you do it.
Definitely. And it's one of the things that I think for a lot of people, it actually can take a weight off your shoulders. Because if you realize that you don't have to beat the market every single year, but you can still outperform the market as long as you're not experiencing the same kind of drawdowns. For me, that was a huge unlock because there's very few benefits to being a small trader, right? Because we get information much later than a lot of other places. We don't have economies of scale. We don't have great relationships with the trading floors or whoever, people are clearing the trades to have better rates, all that kind of stuff. We have way more friction. But one of the benefits is there's no compliance department. You can pivot on a security 5 times in a single day if you're so inclined. The point is agility is one of the few things that are genuinely in our favor. So as the market is going through a really big capitulation, starting to pitch over to the downside, you don't have to sit there and try to clear hundreds of millions of dollars of trades, which if you start doing that in droves like a big institution, that's just going to lead to market crashing because then everybody else is going to pile in because they don't want to get left behind. As a small trader, you don't have to deal with that. So yeah, I think trying to look at some of the benefits that we have in different ways to play the game to outperform the market really changes the dynamic of like what we're trying to achieve, I think at least.
How do you make sure that you actually avoid this downside of the market?
There's a few different ways that you can do it. For me, the largest portfolio drawdown that I had was just over 30%, and it was on a single trade. And that was a few years into trading, like 4 or 5, I want to say. And that was a massive wake-up call, because at that point I was trading short premium strategies, really high probability of winning all the time. And then I started focusing a little too much on how much I wanted to make in this really wide iron condor in the rut. And it ended up temporarily moving against me. Long story short, led to literally over a 30% drawdown on the account on one single trade. So that forced me to kind of like reconsider everything. So for me, what I do now is I institute kind of 3 broad protocols. The first one is I trade a mix of assets and strategies. So I create a little bit of diversity in the portfolio. So like even right now, we're at all-time highs in the market, but I still have trades on that are short deltas, meaning benefiting to the downside. I look for weakness so that I can trade things to the downside, because what I do know is that if the market starts to roll over, the things that are going down today are way more likely to accelerate to the downside. So I keep a mix in the portfolio that way. Then I set very, very specific per trade risk control metrics to limit max total loss in individual trades. Then the third thing is I deploy portfolio level circuit breakers. So let's say I'm trading a broader book at the time, and let's say that I have 150 trades on, something like that. Well, if each one of those is sized well based on a percentage of the portfolio, if all of them draw down at the same time, it can still lead to excessive loss. So what I do is I have specific thresholds for the portfolio that if the overall portfolio value drops more than 10%, I'm going to start cutting trades. I'm just going to start cutting trades. Even if they look good, they don't look good, I'm taking risk off the table. So it's a way for me to manage risk in kind of multiple levels. That's the best possible way I've found so far, because allocation, how much money I'm using at a point in time, is massively important, because you can only lose what you're risking. But I don't just trade options, I also trade futures. And if you have a short call or if you're selling a future, in those contexts, you can lose its undefined loss potential, technically speaking. So you can't count on, some sort of max loss being the investment you put into it. You have to be the max loss. So I use 2 different kinds of stops. I have a soft stop or a mental stop typically, and then I'll have a hard stop. The hard stop isn't always resting, but the hard stop is a non-negotiable exit that's determined before entering every single trade. So every single trade, I will define the exact spot that I'm going to get out. A lot of times, if it's a futures contract, I'll rest the order and I'll just have it live there, leave it good till canceled so that it can fill in the middle of the night if I want something like that. And then the soft stop is kind of like it's a heads up that this thing's starting to move the wrong way, meaningful enough that it looks like it's not working. The vast majority of instances, I exit on the soft stop. But I give myself the choice in case it does look like something might turn around a little bit, something like that. And what I found in the beginning, I used to always violate the soft stop. It essentially just shouldn't have been there. And that's because of the disposition effect. But once I understood that's what I was doing, I really pulled that back pretty massively. So that's really the three main things that I do to limit portfolio drawdown. I use non-correlated securities that I'm trading and strategies. I use a mix. I deploy individual trade level risk management protocols. And then I also deploy portfolio level circuit breakers so that even if all the trades start going wrong at the same time, I'm going to start pulling risk down.
Now that you coach and you work with traders, tell me what are some of the biggest mistakes you see other traders make out there?
It's innumerable. I think the two biggest ones that I can think of, the first one is probably not self-analyzing enough. A lot of people, and that's one of the good parts about having a military background, is like we are brutal at analyzing ourselves. And it's because you grow up in an environment where people are going to be very critical of you. You're going to be very critical of yourself. And you develop this really thick skin. So that helps for like objectively analyzing things. So that's probably the first thing. The second thing that I would offer is completely misunderstanding the landscape. I think a lot of traders like myself, we start trading thinking that it's going to be, fast, easy money. The problem with that is if you think about trading, it's one of these things where you have to wear a lot of hats. You have to be risk manager, you have to be researcher, you have to be actual trader. And there's a lot of things that have to be done well in order for it to work out long term. So that would be the second biggest mistake, is I think people just kind of stumbling into it thinking that it's going to be fast, easy money. And I think for the overwhelming majority of those people, they're going to just lose money. And one of the things that I see a lot is a trader will tell me like, oh, hey, I want to make 20% per year. And then I'll say, cool, show me your trade log or show me your brokerage statements. And they're like, oh, well, I only started taking this seriously 4 months ago, but I think I could do it. And the joke in my mind there is it's like the market couldn't possibly care less what you want to make. Couldn't possibly care less. It's completely indifferent to you, your wishes. It's like nature. It's just there. So traders will have this idea of what they want, which is okay. I think it's completely fine to know what you want. But to think that that's, essentially going to happen right out of the gate is simply delusion. Trading is one of those things where nobody's there to kind of guide you in general. Whereas, for example, I like martial arts a lot. And if I go and I'm training jujitsu or Muay Thai or kickboxing, I'm not going to go into a decent jujitsu gym and they're not going to have me rolling with all their black belts right out of the jump competitively. And they might put me with a black belt to assess me a little bit to make sure that, I'm not crazy and to kind of have like a control. But the point there is I'm not immediately going and competing. But if you think about it in trading, that's exactly what you're doing. As soon as you go and you start trading, you are competing. And you are competing with people that are really sophisticated, that really want to do well. Some of them have information that you don't. So understanding the challenge is probably the second largest mistake I could think after the first one, which is just approaching trading with the wrong mindset, which is an absolute massive problem for people. And then the third thing I would add on to that list is it's like the quote from Ronnie Coleman, He's a bodybuilder in the US. And he has this great quote where he says, everybody wants to be a bodybuilder, but nobody want to lift these heavy ass weights. And what he means by that, everybody loves the idea and the aesthetic of a bodybuilder, but very few people like the idea of actually sitting down, doing data analysis or logging your trades and going through that process literally for years consistently to build the skill set. That part becomes a little bit unsexy. And that's partly due to really predatory practices in the YouTube/social media, financial media space, which is actually one of the primary reasons why I do podcasts like this, is because I try to share both the pros and cons of trading, because there are a lot of both. And I don't think that there are enough authentic voices out there. Most, like social media, financial influencers, they're just trying to pull money out of people who genuinely don't have the money to give at that point. The people that fall for that kind of crap, sitting in the private jet and, trading, it's like the people who fall for that are the exact kind of people who don't have the money to waste on that kind of thing. And it really frustrates me, but that would be the third thing I would offer. So yeah, I think those are kind of like three of the big mistakes I see.
How do you get yourself to do the not sexy work in trading? Something you can do to kind of do it better, or do you just like doing it, or what makes you want to do it?
It's learn to love it. In the Marine Corps, we call it embrace the suck. Do it like you love it. And I adopt that mindset straight from the jump. So sitting down and like logging your trades, it's monotonous, it's kind of boring, but I don't allow those thoughts. Like when it comes time to log the trades, I don't sit there and think to myself like, oh crap, I don't want to do this. I don't allow those thoughts. And the way that I encourage myself to like really focus on it is, again, going back to that compound growth calculator, because seeing the ability to become a millionaire before you're 30 and to see what you can do with that money then from there is very incentivizing. If you can embrace an element of delayed gratification, meaning sacrificing up front, the sneaky part about delayed gratification is the more you delay gratification up front, the sooner you get to it. Kind of a cool function. So that is what I continue to look at when I didn't want to do something, when it didn't feel like I wasn't in the right mindset after rugby practice or something to like sit down and start reading again. And I literally would think about that. I would think about like, if you build this skill set now, in the not so distant future, you're going to live a lifestyle that you will really enjoy. It's the kind of lifestyle that most people tend to aspire to. But again, going back to that previous thing, they like the idea of it, but they don't like the work that it takes to get there.
Tell me how people can find you and connect with you after this podcast.
Yeah, for sure. So people can find me if you just go to my website, it's outliertrading.io. Everything's there. And then I'm also on YouTube at the same, Outlier Trading.
Awesome. I'm putting below that. You can check you out there and they can connect with you for sure. I really appreciate the advice that you gave, Erik. It's been a lot of good value for sure. Hopefully we can catch up soon and discuss trading again.
Awesome, man. Yeah, thanks for having me. Thanks for doing what you do as well, because I think I've listened to a couple of the podcasts that you've done, and I think it's really cool that you put people out there to share solid information, hopefully that can help others. So thank you for doing what you do.